So given the challenging environment that we're going into in 2023, most of our clients are looking for strategies that are both tactical, defensive, and can generate income. And we think that the Premium Yield Fund delivers on all of these things. It's been an incredibly difficult year for markets with a bout of uncertainty, heightened volatility, and recessionary concerns going forward into 2023. When we talk with most of our clients looking forward into 2023, most of them are looking for absolute return strategies that are very tactical and defensive in nature that can potentially weather another downturn in the economy. PYF, we think, is one of those strategies. It's incredibly tactical. It harvests volatility, meaning we can take advantage of the volatility in the market to deliver a very attractive premium to end holders. It did really well in 2022 when most traditional assets were all down. So it was basically the first time in over 150 years when both long bonds and equity markets were down over 10%. PYF actually returned just shy of 6% on the year. So we think that in terms of setting it up as a diversifier, which can generate absolute returns in a recessionary type environment, that is well positioned. And the way we think about it is that PYF is an alternative that kind of sits a little bit in between equities and a little bit between credit. So not quite either asset class, more in between. The outlook going forward, we think, is going to be very robust for an option selling program. So when you look at the distribution of returns in the S&P 500, so rolling 1 month returns over a longer period, the actual most recent period from 2016 to 2021 wasn't that great for a put-right strategy. But we think that's going to actually change because the regime is different. So looking at this table, you can actually see that the gray bars highlight the period from 2016 to 2021, whereas we think a more normalized period for S&P performance, where there's going to be more modest returns, is captured in the blue bars from 2000 to 2012. You can notice also in the most recent period, more observations on a monthly basis occurred with the S&P returning over 1%. So the way to think about that, and what we contend, is that the Fed-induced massive stimulus basically really turbocharged returns to the top side. So really, the last 5 to 6 years of the S&P is really all about owning beta and as much beta as possible in order to kind of outperform markets. That regime has actually changed now. So we actually think that the blue bars in a more normalized distribution is probably going to be the way forward. And usually in that market, what we're going to see is more two-way risk. So in these kinds of environments, you're not going to see so many upsized returns to the top side, and you're going to actually see more months where you actually see a monthly return on the downside. And that actually really suits an option program that's going to be selling puts and calls on either side. So the ability to basically be tactical on either side and then harvest this kind of volatility going forward, I think is going to be very important. So if you look at this graph, the light gray line is the S&P 500, and the brighter white line is a 2% out of the money put right on the S&P 500. PYF is much more sophisticated. Basically, we're writing on more single names across different tenors. But what we think this index actually indicates is proof of concept for the strategy and why we actually think it can do well over different kinds of periods. So if you actually look at the Great Financial Crisis from 2007 to 2009, we think a put-right strategy massively outperforms the S&P 500 and kind of sideways to down markets. And the way to think about that is you get to harvest extremely high volatility levels, which is good for generating premiums. And then you're also not lagging the overall index because you're not going to see those giant spikes to the top side. Sideways to down markets, coupled with high volatility and the ability to generate premiums and be tactical, really lends itself to this kind of option strategy.